Welcome everyone to the Kimberlite webinar for hydraulic fracturing. My name is David Batt, President of Kimberlite Research, and I'm glad that you're able to join us today. This is the second in the Kimberlite webinar series. Our first webinar in June provided an update on drilling services, including downhole mud motors, MWD, rotary steerables, drill bits, and fluids. Let us know if you or your colleagues need access to the drilling services webinar, and we can provide that to you. Just simply send us an email or a chat message today, and we'll send you a link to the drilling services webinar. Also, feel free to submit questions during the presentation via the chat box, so you can email us directly, and we'll address the questions during the presentation. For those of you that may not be familiar with Kimberlite Research, I will provide a brief background and then dive into the 2020 hydraulic fracturing report. Kimberlite Research provides voice of customer feedback each year via personal phone interviews with nearly 3,000 E&P operators and users worldwide. Some of you on the webinar with us today may have participated in one of our studies in the past, and for that I say thank you. Our research is approximately 50% North America and the other 50% international. We'll produce a series of reports each year that cover topics ranging from formation evaluation, drilling services, completions, production, and subsea. We also have a report that addresses pipeline, inline inspection, and integrity management. Today we'll be focusing on the hydraulic fracturing report that's based on interviews with completion engineers and completion managers. In the hydraulic fracturing report for 2020, we personally interviewed 197 users, of which most were North America land. Of these 197 users, it represented 130 different E&P operating companies. These interviews took place during the months of June and July of 2020, and the report was published in August of 2020. The 2020 report is a continuation of the reports we published each year since 2016 and provides good trends. In the report that I'll cover here, we'll be providing an update on future activity and trends, technology needs, adoption rates, operational issues, and supplier performance and competitive position by basin. So with that, let's dive into the report. One of the first questions we often are times asked as we talk to operators and service suppliers and investors alike, and that is, what does the operator sentiment look like? We track operator sentiment for hydraulic fracturing as well as other service lines. And the most recent decline in oil prices and demand has led to operator sentiment reaching historic lows. As you know, any sentiment indices above 50 indicates market expansion, below 50 indicates market contraction. You'll note that the hydraulic fracturing market was already in contraction mode entering into January 2020 due to the tremendous drilling and completion efficiencies achieved in the market, requiring fewer drilling rigs and fewer hydraulic fracturing crews, creating an overcapacity of equipment and services. And so, even as the coronavirus took place in middle of March, coupled with the oil price war of Saudi and Russia, that only compounded a very stressful situation. And one of the biggest differences between this downturn and the prior downturn of 2014, 15, 16 was in 2014, 15, and 16, it took 20 months before we reached bottom in the summer of 2016. So during that past downturn, I can't tell you how many times we would hear, are we there yet? Are we there yet? Well, for this particular downturn, we're there. We arrived fast and we arrived hard. Drilling rig count dropped precipitously from about 780 drilling rigs down to where we are today, about 240, 250. Frac crews dropped from about 350 down to a low of 45 frac crews back in May time frame, 45 to 50. And we're back up now with frac crews at about 75 to 80. So the hydraulic fracturing market is beginning its recovery. But for drilling rig count, operators report that due to budget exhaustion, they really won't be picking up materially any drilling rigs until 2021. But with oil prices in the high 30s and low $40 range, the economics certainly support completing drilled but uncompleted wells or DUCs, and that's what we're seeing taking place here in the second half of 2020. Looking ahead into 2021, even though operators' budgets have clearly not been formally established or approved, based on responses from 192 respondents in U.S. land and Canada, the U.S. land operators are anticipating to drill 15.4% more wells in U.S. land in 2021 versus 2020. Most of the activity, as you can tell, is anticipated to take place in the Permian Basin, which is exactly the basin that led us out of the 2014-15 downturn. All the other non-Permian basins in the U.S. are anticipating projected increases of sub 10% at the current time. We'll continue to track operator trends and anticipations for 2021 as we produce a series of other drilling services reports at the end of the year dealing with surface wellheads and as well as cementing services. If you translate this 15% increase in wells to be drilled in 2021 versus 2020, while it's encouraging, keep in mind it's off a historic low base. And if you translate that into projected drilling rig count, if we exit this year at 240, 250 drilling rigs in 2020, this anticipated level of increase really only points itself towards an addition of about another 85 to 100 drilling rigs. So certainly there's evidence to suggest that in 2021, rig count can increase back up to close to 350 drilling rigs. Now, one of the trends that we're certainly seeing in the marketplace is many oil and gas operators are realizing that we're beginning to reach the end of the road of traditional price discounts that take place in the market, in large measure because the oil field service companies literally don't have any additional discounts to provide. And so about 45% of the operators interviewed realized that, hey, look, traditional price discounting is simply probably not going to occur. You can look at the financials of the oil field service companies and see how distressed they are. Many oil field service companies and hydraulic fracturing have exited the market, like BJ Services, Basic, Superior Energy Services, FTS filed for Chapter 11 bankruptcy protection yesterday. So while 55% of the E&P operators in U.S. land expected that perhaps there would be some additional discounting taking place, maybe to the tune as much as 6.9%, another 45% of E&P operators, when we interview them, were sharing with us the fact that there's probably just no additional room to go. That's not going to save them. In fact, what we see is a theme more towards E&P operators looking towards a flight to quality to try to identify those hydraulic fracturing service suppliers that they can proactively collaborate with to help jointly identify cost-out opportunities and drill efficiencies in the field up. By increasing drilling and completion efficiencies and looking collaboratively for cost-out opportunities, that's probably going to be the biggest opportunity since there's really no additional room for price discounting, and that's certainly evident in the financials of the oilfield service companies. One thing that we did ask in the 2020 report that we did not ask in the 2016 through 2019 reports was, given this unprecedented market that we're in, seeing prices go negative in April for the first time in history, what actions are the E&P operators taking to reduce well cost? And it was interesting to see that 28% of the operators in U.S. land indicated that they were reducing sand and chemical usage. Another 17% cited use of focusing on efficiencies and technologies, some quick connect systems and monolines and other ways to kind of drive efficiencies in the field, as well as reaching out to their hydraulic fracturing service suppliers, looking for collaborative efforts to try to figure out to drive efficiencies and operation efficiencies in the field up and cost out. In terms of the other thing that we noticed was that E&P operators in U.S. land were increasing the length of the wells, but also increasing the stage length. So in many cases, instead of having 100-foot stages, we saw some of the operators beginning to lengthen the number of stages out to 150 feet or even 200 feet, which is basically reducing the number of stages per hydraulic fracturing job, as well as increasing the spacing between the laterals. One thing that we've been tracking at Kimberlite each year is the tremendous drilling and completion efficiencies being achieved in the marketplace by the U.S. land oil and gas operators. And Sean, it looks like several people may need to call in on the phone to listen if their computer audio is not working. What we noticed in 2020 is that the U.S. land operators report drilling the length of their laterals increased by 4.5%, while the number of days to drill the well decreased by 1.4%, and the number of days to complete the well decreased by 6%. So we're still seeing very strong drilling and completion efficiencies in the marketplace. The Canadian operators tend to lag the U.S. operators by 1 to 2 years, and they're just now beginning to increase the length of their wells to be a little bit more on par with U.S., as well as the number of stages as well. But you can also see here in the United States land how the U.S. land operators, in an effort to reduce costs, they're backing off on sand and proppant that I mentioned earlier, as well as backing off on the number of stages being used. Another key topic as we transition here to a few technologies here is dual fuel versus all-electric hydraulic fracturing systems. And we asked this question slightly differently in 2020 report to dig in a little bit more deeply. And what we find is that the operators really prefer dual fuel over all-electric by a 2-to-1 margin here. In a large basis, because as you know, dual fuel is not a new technology. It's been around quite some time. It has an established track record of good performance and familiarity with many of the operators. And it's certainly viewed as being much more cost-effective than the CapEx-intensive all-electric units. Now, the operators certainly recognize that the cost savings associated with displacing diesel fuel provides a very strong economic, compelling reason to continue the adoption of dual fuel in electric. And so we expect both these technologies to grow. However, dual fuel is certainly the operator choice right now by a 2-to-1 margin. Even the operators that mentioned that they really do prefer electric due to the lower emissions and lower noise levels, many also said, look, the price currently is too high, and while they prefer it, they really need to see some improvements in commercial structure and costing before they would probably jump towards electric. One of the things, too, that we track is the bundling of chemicals with the hydraulic fracturing service supplier and the bundling of proppant. And what we find is the large independent operators tend to unbundle at the highest rate, with 45% of the large independents bundling their proppant purchases with the pumping supplier, and the other 55% of large independent oil and gas operators surveyed preferring to go out and purchase their proppant separately. If we look at some other technology trends as it relates to sand and diversion and dissolvable plugs and such that I'll take you through real quick, we noticed that the use of local brown sand continues to increase. So if you go back to the 2017 survey, it was 16%, but now in 2020 it's up to 41%. If you look at it by basin here, what you find is that the use of local brown sand comprises nearly 2/3 to as much as almost 3/4 of the sand use in the Permian Basin, Eagle Ford, and Mid-Continent. Now, one of the observations here is, myself being a geologist, that local brown sand is brown for a reason, has a lot of clay and micaceous fines. There are many in the industry that believe that some of the sand quality could be so poor that we're actually partially plugging the rock as we're trying to prop open the rock. And, this may lend itself as to why we continue to have U.S. land operators report that 15 to 20% of their well completions do not meet expectations, principally due to not understanding the subsurface and the reservoir itself, and just really going about hydraulically fracturing and completing the well geometrically rather than trying to pinpoint the sweet areas of the rock. But here what we see is there could be some influence if the sand is of really poor quality, that these micaceous fines may be having some detrimental effect as well, since it's increased so much recently. Cost is still the major driver in the selection of the proppant being used, but I do think we should be paying more attention to the quality of the sand being pumped into the well. If we take a look at the length of at the amount of pounds of proppant used per lateral foot, as you can see at the top of the screen, overall sand did decline, and just about every basin showed decline in use of proppant with the exception of the Haynesville. When we look at proppant storage, handling, and delivery systems, when we first started tracking this, silos and boxes were about even 50-50 in terms of preference. But boxes tend to be winning out over silos slightly, even though there's certainly room for both. In the Permian Basin, it's still split about 50-50. Operators that prefer box systems just believe that, due to the logistics and efficiency of loading and unloading, it fits the cadence of their operational logistics on the ground, and they certainly believe that it has less dust. Those preferring silos certainly prefer the smaller footprint and the highest storage volumes, particularly if they're in remote areas. Use of dissolvable plugs has been increasing every year for the last several years, but for the very first time, it looks like we see a slight pause. We see increase in the use of dissolvables in just about every basin that we track for this hydraulic fracture report, with the exception of the Permian Basin that backed off a little bit. And because the Permian Basin makes up 40-50% of the market, it caused kind of a stagnation in the overall increase in the number of dissolvable plugs being used. Even though most operators do plan to continue to use dissolvable plugs, the number one contention on the use of dissolvable plugs is the consistency of the rated dissolvability. So I know 9 Energy and others are coming out with low temperature dissolvables, but quite candidly, if the consistency and the dissolvability of these dissolvable plugs does not increase, this rate of increase that we see by the operators may begin to attenuate and slow down a little bit. Interesting enough, the use of diversion overall in U.S. land actually declined, even though in the Eagle Ford we saw that it increased. It seems that U.S. land operators are experiencing some mixed results in certain applications with the use of diversion, and for the first time we saw that back off a little bit. In terms of quick connect systems and monoline systems, these are relatively new technologies that have gained quick adoption, where quick connect systems now comprise about 52% of hydraulic fracturing operations, and monoline systems about 29%. I'm going to shift gears here on you and take a quick look at some of the perceptions of the hydraulic fracturing service companies that are out there and the brand strengths, and then we'll dive into supplier performance and competitive position. It's interesting to think that approximately 63%, nearly 2/3 of operators believe that hydraulic fracturing services are indeed becoming a commodity. But amongst the 37% of the operators that do not believe that hydraulic fracturing services are becoming a commodity, when asked which frac supplier offers differentiating performance and differentiating technology, if you go back to 2017 surveys, 71% of the U.S. land operators and North American land operators would have cited Halliburton as being that differentiating supplier. But what we find here is that the brand strength and perception of Liberty Oilfield Services now rivals that of Halliburton in terms of brand strength and brand perception, even though Liberty Oilfield Services is a much smaller supplier than Halliburton. And so even though Halliburton is historically the leader in hydraulic fracturing, particularly in terms of market penetration and market share, and certainly legacy and history of pumping services, in many cases their image and brand strength has been declining as Liberty and has been increasing. If I were to change gears on you just a little bit, I want to cover this topic before we continue. We continue to see 15 to 20% of the wells completed failing to meet performance expectations. That number is high as 17 to 19% in the Permian, Eagle Ford, and Bakken. I do believe that the onset and increase in the use of brown sand probably has some correlation to what's going on out there in terms of some of our experiences, but also there is a lack of understanding of the subsurface reservoir, and we still continue, due to the tremendous operational synergies on the surface, of just geometrically completing our wells rather than trying to pinpoint a little bit more effectively. When we take a look at which suppliers are associated as having the most reliable equipment in U.S. land, what we find is Halliburton still has that biggest market image, followed by Liberty. And for those that are associated as having the best overall field service in the marketplace, you can see that the brand image and strength of Liberty continues to challenge that of Halliburton. So when we run our marketing analytics for brand image and brand strength, what we find in the marketplace is that Halliburton continues to have an image and perception in the market as being the technology leader. They also have an image as being that premium-based supplier that costs more is worth it, and they're not viewed to be a low-cost supplier. So still a very strong brand image for Halliburton in the marketplace. If we take a look at Liberty Oilfield Services, what we find is that they are the only mid-tier supplier in the market that has a market image and perception that propagates larger than their customer base. So their brand strength is strong, and that operators are beginning to associate them as having really strong field service and reliability and technical support in being a premium supplier. Most of the other mid-tier suppliers, be it NexTier or Calfrac and a host of others, have really brand deficits with respect to, even though Universal and others have very strong track records of performance over the years, their track records of performance are not really well known by the E&P operators, indicating really an opportunity for these many mid-tier suppliers to really do a better job in communicating their track record of performance and history with the E&P operators. I'm going to shift gears into the main section of the report, where we interview the E&P operators and we ask each of the E&P operators and your peers in the industry what suppliers they use to hydraulically fracture their wells. You can see from 2018-19, Halliburton is continuously penetrating the market at about the 50% level, meaning that about 50% of the U.S. land operators that we interviewed for this 2020 report indicated use of Halliburton. You can see that the other mid-tier suppliers are being used by 5, 10, even 20% of the U.S. land operators, but most of the U.S. land operators have not used these other mid-tier suppliers. In fact, the number of suppliers being used by the typical E&P operator has declined from 2.66, nearly 3 suppliers back in 16-17 timeframe, down to 1.89 or closer to 2 suppliers in 2020. We're also seeing some consolidation in the market as due to the tremendous efficiencies in the marketplace in drilling and completion that have led to an overcapacitization of equipment and a lowering of pricing in the marketplace. Many of the suppliers are having to exit the market, as we talked about earlier, and we're down to 24 suppliers versus 30 in prior surveys. When we ask the E&P operators to rate the performance of the suppliers with whom they use on a scale of 1 to 10, with 10 being outstanding performance, one of the first things that you see on this chart is that the worst performing hydraulic fracturing service suppliers are getting customer reviews from the E&P operators that use them in the 6s and 7s, and the hydraulic fracturing service suppliers that are getting customer reviews on a scale of 1 to 10 are getting the highest ratings, up in the high 8s. And so you see a big variance in the performance between the very best performing hydraulic fracturing service suppliers and the very worst performing hydraulic fracturing service suppliers. And so keep in mind that question earlier where 63% of the operators believe that hydraulic fracturing service suppliers are indeed becoming a commodity or a commoditized type of offering. The fact is that through the voice of your peers in the industry, you do see quite a bit of variance in the performance of these suppliers. And with the gift of your customer reviews, we're able to start to track supplier performance from year to year for each of the suppliers versus industry average. I think it may be easier for me to share some of these performance trends with you if I go into our software and interactively show you for U.S. land on responsiveness to needs. You can see that the industry average performance ratings for responsiveness to needs at the top of your screen have actually improved from 2017 to 2020, indicating that you and your peers in the industry are generally becoming a little bit more satisfied with the customer responsiveness that you are receiving from the hydraulic fracturing service suppliers. You can see that Halliburton's customer reviews and customer ratings in U.S. land for responsiveness to needs have generally lagged the market, but not too terribly, but they're certainly not the performance leader in providing customer responsiveness and customer experience. If you want to see a market laggard, you look at BJ Services, where they consistently lag the market, and as you know, they're now exiting the business. But there's probably a correlation between BJ Services' performance and their exiting of the marketplace. Whereas if you take a look at Liberty Oilfield Services, you can see that their customer reviews each year from 16, 17, 18, and 19, and 20 are consistently higher than the industry average. So my point that I'm trying to emphasize here is not all oil field service companies perform the same. If I remove my mouse and you can see the spaghetti that looks like on this map here, you can see that there's quite a wide diversion. Even when you get to equipment quality and equipment reliability, which is a really key performance metric, performance ratings by the E&P operators have improved in 2019 and 20 after seeing reliability declines from 16 to 17 to 18. And so the reliability of the pumps and blenders have generally been getting better and better, which is important considering the fact that we're going to almost 24-hour pumping operations. And then if we start to go to simultaneous hydraulic fracturing, there'll be a whole nother level of improvement in efficiency. You can see Halliburton, however's performance for equipment quality and reliability is generally better than industry average. You can see Liberty's is way better than industry average, whereas certain other suppliers like FTS International has historically received reliability ratings and customer reviews that are below industry average. This is an area that mixed here, which is now the combination of several suppliers of Keene and C&J and Trican and Rockpile, they'll continue to show improvement as well. So if we take all these performance ratings and we start to translate them into a value map where we can start to look at the overall competitive position in the marketplace, this is what we find. What we find is in United States land on this 2x2 grid here, and I better explain this really quick before diving in, but we plot supplier performance on the x-axis right here. Industry average performance is at the midpoint of the x-axis. So any of these suppliers that plot to the right-hand side of this x-axis, their customer reviews by the E&P operators that use them and rate them on a scale of 1 to 10 are giving them performance ratings that are better than industry average. So Universal, Calfrac, Halliburton, and Liberty are all receiving overall customer reviews that are better than industry average, and the other service companies are getting performance reviews overall that are below industry average. On the y-axis, we plot pricing competitiveness ratings, and the midpoint of the y-axis is industry average pricing competitiveness. So you see Liberty and Halliburton are viewed as charging prices higher than industry norm, whereas Universal, Calfrac are viewed as charging prices below industry norm. However, even though we can track their movements from year to year, what you'll find is that the competitive performance and positioning of these suppliers change by basin. So when you go into the all-important Permian Basin, and as I pointed out earlier, is the E&P operators said, look, David, there's really no more price discounting to get. The next level of efficiency is going to come through technology and collaboration in finding good quality hydraulic fracturing service suppliers that I can count on to work collaboratively with me. What you find is in the Permian Basin, there are several good hydraulic fracturing service suppliers that rate really well from their customers. From Universal, that's very small, to next tier, that is the combination recently of C&J and Keene. Halliburton rates well in the Permian Basin and certainly lives up to their market image of costing more money but worth it. Calfrac is small but well-positioned, ProPetro is well-positioned, and Liberty Oilfield Services. However, if you operate in the Eagle Ford, the competitive landscape looks significantly different with Halliburton and Schlumberger. Even though they get a large share of the business, they're certainly not viewed as the best performers, as other smaller mid-tier suppliers like J4, Legend, FTS, and Universal are viewed as outperforming. When you move to the Bakken, you can see that Liberty performs well as a premium-based supplier. Halliburton and Schlumberger and Calfrac are all considered to be worth what paid for in delivering acceptable levels of value. Mixed tier is viewed as performing exceptionally well and positioned to maybe gain some market share as the market begins to recover in the second half of 2020 going into 2021. When you look in the Rockies, this is certainly Liberty's backyard, and really very few, if anyone, can really challenge Liberty in their overall performance in the region. It looks like Calfrac had a few customers that rated them, but they're really small in the region. But the customers that did rate Calfrac did give them very favorable ratings that compared favorably to the ratings received by Halliburton's customers, next tier, Schlumberger's, and a host of others. When you look into the Marcellus in the Northeast, what you find here is that ProFrac's performance, if you look at the performance trend, which is not shown here, Profrac's performance has declined in the Marcellus, and they used to be down here in the bottom right, but they're now currently performing on par with industry average. Universal and Calfrac are really positioned based on customer reviews as delivering some of the better value in the Marcellus region. Mid-Con, it's largely kind of a Halliburton territory, followed by Schlumberger, and you can see Halliburton is not necessarily living up to their promise as being that premier provider. They need to improve their performance profile to move over to the right. Architects, Haynesville, you can tell Schlumberger is competitively vulnerable, even though they have a large share of the market in that region. And in Canada, Calfrac is the market leader. On frac sleeves, we do have some information on frac sleeves, but if it would be possible that you could contact me maybe off record here, I could maybe do that. Let me see here. Let me see any other questions that have come in. All right. I just had to look at the questions real quick. So let's do a quick summary for Halliburton. So what's been going on with Halliburton here? Well, you can see Halliburton actually performs well in the Permian, Bakken, Canada, and Haynesville. There, they live up to their market promise. They're viewed as good values based on customer reviews. You can see that if you're operating in the Marcellus, Mid-Con, Rockies, and Eagle Ford, Halliburton may not be your first choice. If you look at Halliburton's customer loyalty ratings as measured by the Net Promoter Score, their customer loyalty ratings on the bottom right-hand part of this graph, this solid red line, was always higher than the industry average, the black dashed line. And Halliburton's customer loyalty ratings improved every year, so that's a great testament to them. But the industry average benchmark performance improved faster than Halliburton, and now Halliburton has a customer loyalty deficit. This is a classic example of a good oil field service company like Halliburton showing continued progress overall, but their level of progress is lagging that of the progress of the overall market. You see, there's a question. Okay? There's about a 25-30 second delay on some people's internet latency. Sorry about that. But what we find here is Halliburton's customer loyalty rating is improving. The market is improving at a faster rate. So even though they're improving, they're actually falling behind. You can see that Halliburton continually performs better than industry average on technical support and equipment quality. They tend to suffer with customer experience and how they interface with the operators. Schlumberger's performance is inconsistent. They took on the OneStim assets from Weatherford, and integration of those OneStim assets probably set them back. They probably never needed that horsepower given the way the market played out. If you're trying to find a silver lining for Schlumberger, is they're positioning the Permian Basin, although it's not in the proper top right-hand quadrant where it needs to be. It is improving each year, and it's getting closer to the top right-hand quadrant. Their customer loyalty continues to improve, even though it continues to lag industry average customer loyalty. If you take a look at Liberty Oilfield Services, you see that they perform well in most all basins in which we currently get customer reviews for them on. Their performance is consistently better than industry average, and their customer loyalty ratings are consistently better than industry average. There's a question that came in about the change in sand dynamics, given the fact that people use the local brown sand due to the cost of it. I think until the oil and gas operators begin to realize what impact all that dirty brown sand of different qualities and the micaceous fines is really having on the pore throats and the plugging of the rock versus the propping of the rock, I don't know if it's going to change. If we look at NexTier here really quick, what we find is that NexTier is well positioned in the Bakken, Permian, and Mid-Con. They're certainly poised to do well as the market continues to recover in the second half of 2020 going into 2021. Calfrac is a relatively small provider here in the U.S. They're much larger in Canada, and they're well positioned in Canada. But of the few customer reviews we're able to pick up, I think they had about 4 frac fleets working in the U.S. at the time we did the interviews in June and July of 2020. Their customer reviews were quite favorable. and their customer loyalty ratings are consistently better than the industry average. So if you're looking for a flight to quality, that would certainly be one to look at. FTS International performance has consistently been positioned as more of a discount provider using attractive pricing to offset overall performance shortcomings. But if you look at FTS International by basin, you can see that their performance was distinctively rated as being better in the Haynesville and Eagle Ford than it was in the Permian Basin. Universal's performance and competitive position shows significant improvement in the past year on customer responsiveness and experience, field service execution, technical support, and completion efficiency. Universal has a strong track record of performance in the Marcellus and continues to rate well in the Marcellus, and continues to rate well in the Eagle Ford and Permian based on the customer reviews. ProPetro is a Permian Basin only operator. As you know, they've experienced some difficulty most recently with their reporting structure and change in management. They historically plotted in the bottom right as a value advantage, and it looks like they've adjusted their pricing strategies to be positioned as a cost more but worth it premium supplier moving forward. ProFrac, principally Marcellus, and we talked about that earlier. They've moved from the bottom right to just be on par with industry average. They've expanded into other basins, including the Haynesville and Permian, but their expansions into the other basins have not gone as strongly as they probably would have liked. CUD generally underperforms the market, but the Mid-Con was the one area that their customer reviews were viewed as being best. BJ Services, I kept it in here to show that obviously they're exiting the market, but you can see they were consistently year on year underperforming the market. And then Trican in Canada underperforms Calfrac, but their performance did improve from 19 to 20. So I think, and I'm going to open it up and see what additional questions we have here really quick. I think, you know, some of the observations and messages that I really wanted to emphasize with everyone is, even though in many cases hydraulic fracturing service suppliers may appear to be a commoditized offering, one of the things that we see is there's quite a bit of variance based on your customer reviews of how these suppliers are performing. And in fact, some of the hydraulic fracturing service suppliers are actually delivering better value in certain basins than they are in other basins. So I'd encourage you, when you do your due diligence, I recognize it may be difficult for you to evaluate a supplier if you've never used them before, and certainly that's a relevant argument. But, you should reach out to as many sources as you can. You can reach out to us, and we'll help you if we can as well, to look for sources that can help you in establishing your supply chain strategies or expanding your supplier base, or just looking for best value in the marketplace. Question going back to electric versus dual fuel. You mentioned the cost of the electricity being the hindrance. It's not really the cost of the electricity, it's the CapEx cost for the $20 million turbine out there for the electricity. There's a lot of dual fuel technology and fleets that are already out, because the dual fuel technology's been around for 10 years or more, and so not having to go back and put that high upfront CapEx cost for the all electric fleets is really what's driving the dual fuel. Certainly, regardless if you use electric or dual fuel, the operators recognize by not having to use diesel fuel, you save a significant amount of money. And so the economics look quite attractive, not to mention the lower emissions. And so we certainly see the movement towards dual fuel in electric continuing to grow, but we see that dual fuel is going to grow far more quickly than electric due to the fact that the operators have an established track record of performance with dual fuel, because the technology's been around for many, many years, and just due to the lower cost threshold that there's not a big CapEx payment required to get that turbine out there. Let me see here. Any other questions? We are at 12:40, and I guess out of respect for everyone's time, I know I covered a lot of data rather quickly today. Feel free to reach out to us if you'd like to delve into something in more detail. We'll be issuing out artificial lift reports and production chemical reports in the month of September, and we'll try to hold another webinar series on artificial lift and production chemicals in the month of September. Again, if anyone needs the drilling services webinar link from back in June on drilling services, feel free to reach out to us. And for those of you that participate in these industry studies so we can benchmark supplier performance and provide you some gift of feedback back, we thank you all. And with that, unless there's any other questions, I think we'll sign off here from Kimberlite Research. Thank you for attending.